Have you ever wondered why so many people live paycheck to paycheck, even though they work hard? Why does the paycheck never seem to be enough, and debt keeps growing? The answer often lies in something we're not taught: how borrowed money really works. It all starts with a need. Imagine an average person. They work, pay rent, buy food, cover transportation. One day, they have an emergency, their car breaks down, and they need it fixed to keep going to work. They have no savings, so they use their credit card or take out a loan. At first, it feels manageable. Someone offers them a credit card. They accept it without thinking too much. Then someone else uses it to buy a TV, or to go on a trip. The promotions say, buy now, pay later. And people fall for it. For a while, everything seems fine. But then the time comes to pay, and that's when the trouble begins. Nobody explained how interest works. No one told them about the billing cycle. Nobody read the fine print. That's when they enter the world of debt. A missed payment, an unexpected fee, and a debt that keeps growing month after month. By the time they realize it, it's too late, they're stuck. Types of debt that trap thousands. Credit cards, a tool or a trap. A credit card can seem like a useful tool. It lets you pay even when you don't have the money at the moment. But it's not free money, it's borrowed from the bank, and like any loan, it has rules. Billing cycle. This is the date the bank uses to calculate your monthly spending. For example, if your billing cycle ends on July 10th, it includes all purchases made from June 11th to July 10th. Due date. You get a few extra days, usually 15 to 20, to pay what you owe. This is called the grace period. If you pay the full amount before this date, you pay no interest. But if you only pay part of it, or just the minimum payment, the bank charges interest on the remaining balance. Sometimes more than 30% per year. You spend $500 on your credit card. Your billing date is the 10th, and your payment is due on the 25th. If you pay the full $500 before the 25th, no problem. But if you only pay $50, the remaining $450 starts generating daily interest until you pay it off. What about the minimum payment? It seems convenient, but it's a trap. It only covers a small portion of your debt and interest. If you only pay the minimum each month, you could take years to pay off a small purchase, and end up paying double or more. Personal loans, a lump sum of cash. Another common option is taking a personal loan. How does it work? You get all the money up front, for example, $2,000. You agree to pay it back in fixed monthly payments over a set time. This is called a fixed-rate loan. You know exactly how much you'll pay each month. Example. You borrow $2,000 at a fixed 12% annual rate. You're told you'll pay $190 per month for 12 months. In total, you'll pay around $2,280. It's predictable and easier to manage, as long as you don't miss a payment. But be careful. Some loans come with hidden fees, required insurance, or penalties. Always ask, what is the actual annual interest rate, not just monthly? Are there prepayment penalties? How much will I pay in total? Fixed rate versus variable rate. Fixed rate, you pay the same amount every month. You know from the start what the loan will cost. Variable rate, the interest can change depending on economic factors. Today, you might pay $200 per month, but if market rates go up, next month you could pay $220 or more. A mortgage with a variable rate might look cheaper at first, but if rates rise, so do your payments. This can be risky if your income doesn't increase or if you live paycheck to paycheck. Informal loans, high risk. Sometimes people turn to lenders who aren't banks. Friends, family, or even strangers offering cash with no paperwork. It sounds easy, no credit check, no red tape. But the problem is there are no clear rules. Interest rates can be extremely high, and collection methods can be aggressive or even violent. Example: you borrow $500, and they demand $700 in 2 weeks. If you can't pay, they might threaten you or use emotional pressure. With no legal protection, you could lose much more than money. What is over-indebtedness? It's when a person can no longer cover basic expenses, like rent, food, or transport, because all their money goes to paying debts. So they take out a loan to pay another loan, then another. This becomes a vicious cycle, like digging one hole to fill another. Why do people fall into debt? Because they don't have savings. Because the system encourages constant consumption. Because no one teaches us financial literacy. Because advertising tells us we deserve everything now. Because getting credit is easier than understanding how it works. How to break the cycle? Create a budget. Add your income, subtract expenses, and see what you can pay without digging deeper into debt. Pay more than the minimum. Always try to pay your credit cards in full. Prioritize high-interest debts. Tackle those first. Avoid informal loans. You have no protection if things go wrong. Save, even a little. Even $10 a week can make a difference in the long run. Learn before you sign. Read, ask, and understand. Don't sign anything you don't fully get. Debt is not always bad. It can help in emergencies or allow you to grow, if used wisely. But without knowledge or control, it becomes a burden that holds you back. Understanding how credit works, interest rates, billing cycles, and contracts can make the difference between financial peace and a lifetime of stress. It's not about spending less, it's about spending smart. Don't forget to subscribe and hit the notification bell. See you in the next video.